Okay, good afternoon everyone, and welcome to the Capital Markets Day for the SDCL Energy Efficiency Income Trust. My name is Tom Hovhanessian. I'm a director at SDCL, the investment manager for SEEIT. I'd like to start by saying thank you to everyone for attending today, both in person and virtually. We're absolutely delighted with the turnout and for all your continued support for SEEIT. We look forward to joining those of you here in person today for some refreshments at the conclusion of the event. We've got an exciting agenda for you over the next few hours, which will be mostly made up of a series of 4 panels featuring members of our project management company teams alongside SDCL Asset Management and senior leadership. We've also produced some footage for each of the assets you'll be hearing about today that will give you a chance to see them in action. But before we jump into all that, we'd like to set the scene by showing you a video of an exclusive interview our CEO, Jonathan Maxwell, conducted with the Executive Director of the International Energy Agency, Dr. Fatih Birol. At the IPO in December 2018, we described energy efficiency as the third pillar of infrastructure investment, alongside, but distinct from, renewable energy infrastructure and social infrastructure. Today, that remains just as true as it did 4.5 years ago. Energy efficiency investment can be distinguished from renewable and social infrastructure due to the operational upside associated with energy efficiency assets. By contracting with the ultimate user of energy under long-term fixed arrangements, energy efficiency assets typically have opportunities to improve revenues and margins through active asset management and expansion of services for customers. In addition, energy efficiency investments are able to substantially reduce exposure to unmitigated demand risk and energy price fluctuations, as well as other policy factors such as price caps that affect traditional renewable energy infrastructure. Lastly, energy efficiency investment also delivers an attractive yield versus the other pillars due to the generally shorter payback periods versus traditional infrastructure and given the lower levels of gearing and reduced reliance on leverage to achieve target returns. Energy efficiency plays a critical role in the transition and the pathway to net zero, while providing one of the fastest solutions to high energy prices, energy security concerns, and increasingly challenging decarbonisation targets. From Jonathan's discussion with Fatih, you will hear about some of the geopolitical and market drivers that make energy efficiency more important today than ever before. So with that, we'd like to play our first video for today, following which Jonathan will provide some introductory comments.
We're delighted to be joined today by Dr. Fatih Birol, Executive Director of the International Energy Agency. Dr. Birol was on the Time 100 list of the world's most influential people in 2021, and he chairs the World Economic Forum's Energy Advisory Board. Dr. Birol, I'm very excited to be having this conversation today, and thank you for having it with us. Last year, talking about the energy sector, you coined the phrase, the world's first global energy crisis. So what does that really mean for investors, whether it's in conventional or in sustainable energy?
Thank you. Yes, I call just 1 week after the invasion, 1st of March, I call the market developments as the first global energy crisis. The reason is very simple. Russia, the country that invaded Ukraine, was the #1 energy exporter of the world by 24th of February. #1 in oil exports, #1 in natural gas exports, major player in the coal markets, and the actions that Russia took and the responses from the international community meant we are entering the first global energy crisis. And as we all know, there were many issues on military side, on the economy side, social side, but when it came to energy sector, market volatility was the name of the game. And as we see now, as of today, Europe was able to reduce its reliance on Russia big time, first of all. And second, Europe didn't go into recession. This is also very important. But leaving this aside, one important, in my view, reaction to the crisis was many governments around the world understood that the lasting solutions to energy and climate crisis go through clean energy policies. When we look at the numbers, which we do at the IEA, we have never seen the global clean energy transition getting such a big boost in terms of renewables, in terms of energy efficiency, in terms of electric car sales of heat pumps, big growth around the world. And when we look at the investments pouring in clean energy, we are seeing records after records. So when I can go back to, before finishing, the 1970s, some of us may remember there were oil crises at that time, and there was also at that time a response from the governments to oil crisis. I can highlight maybe two of them. One of them was the building a lot of nuclear power plants. It got a big boost. But the second one was energy efficiency. Just before the crisis happened, an average car in the world needed about 18 liters to drive 100 kilometers. And only a few years later, this 18 liter went down to 10 liters for driving 100 kilometers as a result of the response from the governments to improve energy efficiency. So energy efficiency was at that time and is at this time one of the key parts of the response of governments to the crisis.
So let me just take that one step further. Within the context of clean energy transition, partly being a response or accelerated even by Russia's invasion of Ukraine, and with reference to your point on energy efficiency, can we achieve energy security, the climate energy transition, or net zero without energy efficiency?
Absolutely not. We need a few very important cornerstones if we want to build a right roadmap to reach our energy and climate goals, and one of them is definitely energy efficiency. Energy efficiency in buildings, in the transportation sector, in industry sector. This is definitely a key one, and compared to many other jobs we have to do in order to reach our climate goals, it is easier, or I should say maybe less difficult, and it is in our hands. The important thing is to transform our energy system to reach our climate goals requires huge amount of efforts. And most of these efforts are related to making the technologies which are under development, making them commercial. But when it comes to energy efficiency, we don't need to discover new technologies. We just need to put the right policies in place in order to provide incentives, right incentives to the people who are using energy. It can be in Europe, in North America, and in India, and elsewhere. From our point of view, from the view of the International Energy Agency, the agency who prepared the world's roadmap to reaching net zero, energy efficiency is the first and the most important step if anybody is serious to reach its energy and climate goals.
Dr. Birol, it's a massive statement that energy efficiency is the first step. 80% of investment and about 80% of policies aimed at supplying new energy, creating new energy for the market. What you've just said is that energy efficiency is the first step. What policy action can be taken to even out that equation, to promote energy efficiency?
Yeah. So You may know that 1.5 years ago, we made a report which, as they say, shook the energy world in terms of how the world energy need to be transformed if we want to reach our 1.5 degrees goal. And I get a lot of questions from the journalists, from the government leaders. There are many steps to be made. Cutting the investment for oil, pushing the electric cars, the carbon capture and storage. What is the most important for you among all the suggestions you made? For me, number one suggestion is to provide incentive for the consumers to use energy efficiently. And this is not enough, also to provide right regulation standards and norms for energy efficiency. It is the reason the International Energy Agency is working with many countries around the world to provide them suggestions in terms of how we can provide financial incentives, both for investors and also for the consumers and for the governments, how to design to make it attractive for them, so that they understand that the steps taken in energy efficiency is good for their pocket, good for the energy security, and good for addressing the climate change. On one hand, we are doing this. On the other hand, we are organizing several the training sessions for the mid-level government officials to make them understand what kind of legislation they need to put in place in order to further energy efficiency improvement. If we just sit back and wait, energy efficiency improvement will take place, but it will be very, very slow, far from reaching our targets. What we have to do is we have to provide financial incentives, but also we have to put the right standards and norms and regulations there. It is what the IEA is trying to do.
So within the current energy context, in this Russia-Ukraine energy crisis, gas prices actually now, after the warm winter, have come down, Dr. Birol. What's happened? Have we just shifted dependence from Russia to somewhere else? Going back to the point you made about the importance of energy efficiency, not going slow, but now going fast. Is this the moment that we can really step forward and make a more fundamental change in how the energy system works?
Yes, first of all, you are right. The gas prices are in Europe today there where they were before the invasion, but still 3 times higher than the historical averages. And if you think of the Europe's point of view, since you mentioned, if Europe was to be competitive vis-a-vis other economic powers, such as United States, for example, the gas prices in Europe is still 7 times higher than United States, and electricity prices are 3 times higher than China. So if Europe wants to be competitive, Europe wants to use energy much more efficiently. This is perhaps the most important energy source that Europe has, energy efficiency. From that point of view, I believe when we look at the 2022, 10 years from now, so when we look back to 2022, we will see that this year, 2022 and 2023, they were the turning point in the history of energy. We are going to get a big boost to reduce the share of fossil fuels, especially coming from countries like Russia, and see a big growth in clean energy investments, including energy efficiency.
Dr. Birol, can I just say thank you so much for joining us today. We're one of the largest specialist investors in energy efficiency, and we will support all of the activity from the IEA that promotes it in business and in industry and government. Thank you very much indeed for your time today.
Thank you. Thank you very much for inviting me, and I wish all the best to you and to your colleagues. Thank you very much.
Thank you very much.
Thank you. Thank you.
Well, welcome and thank you very much for coming to our event today.
I'd also just like to start with a huge thanks to the SDCL team. I won't name everybody personally, but just to say enormous amounts of time and work have gone in to SEEIT since its IPO and very much so into today in planning and organising today. I'd also like to say thank you to the senior management, the CEOs of many of our largest portfolio companies that are here today, and you'll hear from them directly. In fact, this is primarily what today is about. Many of you have heard from us, SDCL, about energy efficiency, about our investments, about our portfolio. I'm thrilled that Dr. Birol gave us his time as one of the, if not the leading spokesperson on energy in the world, to put energy efficiency into context. But before we dive into the detail of SEEIT, I can't help but just take that one level deeper in terms of energy efficiency and just put things into context a little bit more within SEEIT's investment remit. Just to define what we really mean by energy efficiency, we're talking and why it's so different from renewable energy, because renewable energy is a wonderful, critical feature of today's energy system. We want to see as much of it as possible. But energy efficiency is distinct. It's a distinct strategy, and it means something different. It means ultimately achieving the same economic output using less energy, reducing. So, within that context, why? Why should we be focused on using less energy? And maybe just to give a few statistics to start with. I'll start with the 80% number. First of all, energy is really important if you're interested in anything to do with the economy or climate. But just to pick on climate for a second, around 80% of human-made greenhouse gas emissions come from energy. 80%. But where does energy come from? Because we speak passionately as a society about renewable energy, particularly renewable power. But the fact is that today, just a little over 80% of the world's energy still comes from oil, gas, and coal. And the renewable power that we focus on and we want to see as much of as possible still only represents less than 3% of the world's primary energy. And about 80%, as we discussed on the video, about 80% of investment and policy goes into supplying new energy, particularly new renewable energy. Unpacking the energy system, I'm going to go to another number, 70%. About 70% of the world's energy is used in buildings, industry, and transport. But 70% of the world's energy also is lost somewhere in the extraction, conversion, generation, transmission, and distribution process. Even before it gets to the point of use. And then yet more can be lost at the point of use, somewhere between 20 and 30%. I'll just turn those numbers upside down and go to the 20, 30%, because while that's the number that can get lost at the point of use, 20% is also the same number. The 20% is the proportion of the world's energy that's electricity. 80% is not. So if we are betting on renewable power, which we want to see accelerate as much as possible, but if we're betting on renewable power to address climate, energy security, or economic issues, we have a very long way to go, where 20% of the world's energy is electricity. Around a third of that, 30%, is renewable power. So if you were to green the whole electricity system, it would require 3, maybe 5 times as much renewable power. And if you're going to green all of the energy system, you have to expand the share of electricity from 20% obviously to a much, much larger number. We have a very long way to go in the energy transition. If we were to do all of that, and it will take time and it will take money, but as we go through the process of doing all of that, it will also require very large amounts of metals, minerals to be extracted. The outcome of getting to net zero using these techniques of supply side alone is going to take time and money. And in any case, we can't get there using these instruments by 2030. It's going to take decades to build new generation. What we can do now, rapidly, at the same time, is address that fundamental problem that most actually, of the world's energy is lost. And we can do that by investing in solutions to that problem. That is what SEEIT is doing. SEEIT is investing in energy generation on site, which is cutting out extraction, generation, transmission, and distribution losses. It's investing in energy consumption reduction projects like lighting, heating, ventilation, air conditioning. And it's reducing the distribution and transmission losses by investing, as you'll hear today, in distribution networks and district energy. So I'm thrilled to have great examples of solutions, all of these solutions to these problems, supply, demand, and distribution with us today, and thank our teams for being here. If I pull it all up to SEEIT's investment strategy, our objective with SEEIT has always been to deliver an attractive total return to our investors over the medium to long run through a combination of delivering income and capital growth, in addition to downside protection from the contracted cash flows which cover our dividends. Our objectives were to achieve a 7 to 8% IRR target from our share price at IPO of 100p, and we feel comfortable that we can meet and exceed those objectives. There are several macroeconomic headwinds, having said that are facing all of us as investors today. High energy prices, high inflation, high interest rates. These are macroeconomic headwinds. But they're also the features, high rates, high inflation, high energy prices, that make energy efficiency projects even more valuable in today's market. As Tom pointed out, SEEIT has relatively low gearing. It has a highly diversified, largely operational portfolio. And it's got exposure to attractive markets like the United States, and an extremely effective hedging strategy to cover our dividend and NAV exposures. We've got a very strong organic growth capability within SEEIT. We've got a very, very large and diverse portfolio building. And you'll hear today that there are extremely interesting opportunities for us to nurture and grow our existing portfolio, as well as to take selectively opportunities during 2023 in this higher rate environment selectively make new investments. Coming back to my thanks, we have about 50 full-time employees at SDCL, many of them represented in the room today, but we've got nearly 300 full-time employees at portfolio company level in SEEIT, and you'll meet their senior managers, their CEOs today. Our CEOs are leaders in their field. We have made investments specifically because we're buying into projects, assets, platforms with real expertise and growth behind them, and I'm thrilled that that expertise is represented here today. What does this all mean for where we stand with SEEIT specifically today, in today's extraordinary capital market? I think from investors, you'll hear today about value in our portfolio, and you'll hear about where we're looking to take that value, particularly over the medium to long run. Today's valuation or share price in the market, we don't think reflects the intrinsic value of our portfolio. And therefore, for existing investors, I think offers a very interesting long-term opportunity, and for new investors, frankly, a fantastic entry point and into an incredibly interesting portfolio of projects. So with that, Tom, I'll hand back over to you. Thank you very much.
Thank you, Jonathan. So as mentioned earlier, we have 4 panels this afternoon, each of which will showcase one of SEEIT's bigger investments. Following the panel discussions, we'll open up to some Q&A from those of you in the room. So please have a think about any questions you might like to ask our panelists while listening in. We'd really like to make the panels as interactive as possible, so please don't be shy. And while we're not proposing to burden you with any handouts today, a full recording of everything presented this afternoon will be made available on the company website shortly after the event. Those watching virtually are also welcome to submit questions, which we can address in due course, should we run out of time today. And at the commencement of each panel, we'd like to play a video to introduce the asset and give you a feel for the operations on site. The first of our panels today will be Onyx Renewable Partners. Onyx is a top 10 solar and storage platform located in the United States. And so, if I could kindly invite the Onyx panelists to join the stage, we'll roll the first video.
My name is Mary Beth Mandanas. I'm CEO of Onyx Renewable Partners. Onyx is one of the most established distributed clean energy providers in the United States. The main product and service that we offer is solar and storage. So we take it from the engineering to the pre-construction, and then we are overseeing the construction. But we outsource for local construction companies. So it's on site, and we sell the renewable energy as a service back to the customer. This helps them solve not only some of their sustainability goals, but also it provides an economic savings. Our market is actually uncapped. We do all kinds of commercial enterprises, all kinds of industries. We work with schools, municipalities, and the military. Our geography is nationwide. We've operated across 27 states. We have over 300 projects. We understand utilities, we understand construction, we understand engineering, and our asset management team has been managing the same assets for almost a decade. We currently have about 50 employees, and about 60% of those employees are in customer-facing roles. We provide a service. The customer is the most important. What I want us to create at Onyx is a very diverse and inclusive culture. Onyx's key differentiation is really about the team on the field. We have one of the best teams on the field, I think, in the industry.
My name is Buck Fletcher. I'm the Chief Financial Officer at Onyx Renewable Partners. The Onyx business model is straightforward. We enter into long-term contracts with our clients to deliver clean energy projects on their sites. It's a relatively predictable revenue stream over a period between 15 and 25 years. We certainly see it as a long-term service to the customer, and this aspect of our business helps us and our clients benefit from economies of scale. And it gives us the opportunity to deliver potential new solutions to them as the distributed energy landscape continues to evolve.
Onyx is in the right place at the right time. It couldn't be more perfect. We've got tailwinds related to the climate, related to energy resiliency, related to the need for energy redundancy. Our on-site solutions provide and meet all of those aspects. Onyx Renewable Partners is the one-stop shop. We design, we develop, we build, we own, and we operate the asset for the long term.
Good afternoon, everyone, and welcome to the panel session for SEEIT's Capital Markets Day. For those who don't know me, my name is Purvi Sapre, and I'm the fund manager for SEEIT. And I'm really excited to be moderating the panel sessions with some of our larger investments. During the panel, we're hopefully going to cover off not just what the investments do, but what's been going on since SEEIT acquired them and what the future looks like. Each of the panels will consist of the CEOs of the investments, as well as key individuals from SDCL who are supporting the CEO and the investments through their role as board directors or in other key activities. So without further ado, I'd like to introduce the Onyx panel. Starting at the far side, we have Paul Whitaker, who's head of our asset management and board director at Onyx. we have Mary Beth Mandanas, CEO of Onyx. And as you know, we've got, you know who Jonathan Maxwell is, but he's also chairman of the board of Onyx. So Mary Beth, I'd love to start with you with my first question. You joined Onyx early last year. Can you talk a little bit about your background prior to joining Onyx?
Absolutely. I do have to start. This video I shared with our company, and everyone in our company is so excited about just what we have in front of us in terms of growth. But kind of back to my background. So 20 years in corporate and investment banking, specifically in the power and utility sector. I never thought I'd be in utilities, but here I am. You have a lot of fun facts at cocktail parties with utility regulation. About 10 years ago, I got directly into the renewable space. What I realized after touring Beijing and seeing all the pollution there, and I've got 3 children, is we've got to do something about the climate. And so I started into the renewable space, working with some residential solar providers on the banking side. I got out of the banking realizing that at that point in time, for me to really make an impact, I needed to do it on the corporate side. So I got out of banking, worked as a chief strategy officer for a baby corporate. I've gone from a big corporate to a small corporate, helped grow that business materially, so understand the growth dynamics necessary to really bring a business forward, as I'd like to do with Onyx. And then most recently, prior to joining Onyx, I was working with a utility scale provider. So I've also worked across sizes of projects from very small to very large.
Thanks, Mary Beth. So I'm gonna cover off some areas with you around growth in the market, but before going into that, it'd be great if you could talk about what Onyx actually does.
Absolutely. Well, I think the video provided some idea, but I think it's really, really simple. We're the one-stop shop for customers. So we think about the C&I space, commercial industrial space. So customers need on-site solutions. You know, what Jonathan was talking about in terms of helping customers reduce their footprint. Our solutions are on site or adjacent to their site. So what we're doing is helping locate and provide energy redundancy and energy resiliency, so they're not losing a lot of that power through the grid. We design, we develop, as I talked about, we engineer, we finance, we construct, we own, we operate, and we maintain these assets. So we're with the customer for the life of the asset, providing that maintenance. If something goes wrong, they have someone to call, so they don't have to worry about that, and they can focus on the core competencies of their business. The customers that we have, as I mentioned, are principally commercial and industrial, investment-grade counterparties. And our contracts, to one of Jonathan's point earlier, is for the long term. So our contracts are typically for around 20 or 25 years.
Thank you. And so what was it that made you want to join Onyx in particular?
I love this question. As you know, as we were talking about earlier, I think our product offering, no customer should say no to us. We are providing such a great solution. We customize this solution. It's a huge opportunity to grow Onyx into a leading brand. There's really not another company, I believe, in the United States right now. We're one of the most established players. And we've got the team on the field. We've got the breadth and depth of a management team and expertise that rivals, no other one can, nobody else can rival us. Hopefully I get some laughs. It really is a hidden gem. Our name is Onyx, but it really is a hidden gem. There's just huge tailwinds that we'll talk about later. It's a great opportunity to grow a business.
Brilliant. And now I think would be an opportune time, Mary Beth, and it'd be really helpful to the audience here, if you could talk through a typical Onyx solar and storage project from beginning to end, and put a bit of colour behind that.
Absolutely. As I said, we're one-stop shop. It's simple, it's easy. I talk about it in 6 steps. So really step 1 is the origination and the high-level proposal. So we will come to you. The demand, as I talked about, is huge in our space, and we'll talk about that in a little bit. Step 2 is really we get more information from the client and we come up with a detailed design. So we customize and tailor every solution for the client. Step 3 is contract negotiation. So we talk about this long-term contract, we come to mutual terms, and it's really the execution on that. Step 4, you finalize the design. You work with the local construction company, so it's also about local economic development. Jobs, creation of jobs locally is very important, and kind of how do we give back and provide to the community. And then we begin development with those local engineering and construction counterparties. And then step 5 is that dreaded utility thing. We have to get permits from utilities, and we'll talk about that in a bit too. But it's permitting, developing, and the construction. And then the last step is the utility PTO, permission to operate. And then we go through a punch list, and it transitions to our other customer-facing team, which is our asset management team.
Thanks, and that is a brilliant walkthrough, and especially around the approach you take, particularly around communities. So final question for now, Mary Beth, which is, you've talked about what attracted you to Onyx and some of the special things about just the renewables market. Can you bring together, just in one answer, what is it that Onyx does that's different from its competitors? What does it do differently? What does it do better?
So in one word, it's our team. It's the talent that we have. I talked about how our team, there's nobody else that can rival our team and our expertise. I think the second thing is, and this could be seen as a little more dull, but it's around, we have a process and a policy. We've got to, as we scale, not we've got to scale, we are scaling. It's really about how do you standardize this whole process so that the execution goes smoothly without friction. And I would say those are the 2 things. It's team and it's process standardization of approach.
Brilliant, thank you. I'll give you a bit of a break from questions. Jonathan, we've heard from Mary Beth, and she's talked about Onyx USP and what its differentiation is in the market. So can you talk through what makes Onyx such an attractive investment for SEEIT?
Sure. Well, just going back to what I was saying before, thematically, this is on-site generation. So fundamentally, it's avoiding a lot of the traditional losses in the system from generation, transmission, and distribution. You're getting energy directly where it's needed on-site, so it's efficient supply. I think we recognise we've been looking to make investments in this market in the United States because it's the largest and fastest growing market for this asset class in the world. But we've been looking for an opportunity for quite some time, and we came across the opportunity to invest in Onyx. It really is a standout player has the potential to be an even bigger standout player in the sector in the US. So I think that's the first point, just tremendous potential in a large and growing market. The second point was about yield. So we do look for investments that give us that bedrock of contracted cash flow that can help cover our dividends. And in making the initial investment in Onyx, we are able to acquire an existing operational portfolio of projects under construction, as well as a very significant development pipeline. And that underlying portfolio gives us access to contracted cash flows, which is exactly in line with our mandate. Those cash flows are coming, as Mary Beth intimated, from very high quality, mostly investment grade counterparties. So by Mary Beth's description, when we talk about commercial industrial, we're also within that context, Mary Beth, servicing what we call the MUSH market in the US as well, municipalities, universities, schools, hospitals. So a very high quality set of cash flows to contract with counterparties. But the other feature, I think, just putting it all back together again, is an opportunity for total return. And this is where we have the underlying contracted returns together with an investment in the platform that manufactures these projects. And I think that's what creates the long-term upside associated with this investment. When we made the investment, we acquired 50% of the underlying platform, Onyx Renewable Partners, and that's putting the whole package back together again. Purvi makes exactly the sort of investment that we want to make: contracted cash flows with a total return prospect.
Brilliant. Thank you, Jonathan. And Mary Beth, I'm going to come back to you again. Jonathan mentioned the potential for Onyx to be a standout player in the US market. So let's talk about the US market. What drivers are you seeing for the market tailwinds that are impacting Onyx?
Absolutely. I think that one thing that first thing I will highlight is this is a boardroom discussion. This issue that Jonathan talked about, that we're talking about here, it's risen to the boardroom. Never before in the U.S. have people really worried about power resiliency. They've taken it for granted. It's an entitlement. It's not happening anymore. It's not as resilient. There's also risk around climate change, kind of parallel path with that. And there's also a lot of concern about power cost. What is my cost going to be? Where are utility rates going to go? How can I think about the economic benefits of doing something else? What is that something else? That something else is on-site solar and storage. So that's, number one, boardroom discussions. All of those risks are being talked about. Number two is there's, of course, a real focus on decarbonization. And it's not political anymore. It's really not. People are realizing the economic reality of loss of power due to a storm and the grid's down. There's actually huge savings with our solution. So we provide economic savings. Every single project we do provides an economic savings. And the third big tailwind, of course, is the Inflation Reduction Act, a $370 billion program. Never before has our space had a 10-year runway. It's been fits and starts. It's been 2 or 3 years, and then they let it lapse, and then they'll start it again. And that's called what we have the name as the solar coaster, up and down and up and down. But now we've got a 10-year runway, and this Inflation Reduction Act could be $1 trillion. I mean, it's huge, absolutely huge.
So what are you and the Onyx team doing to take advantage of all these tailwinds?
It's origination. We are having so many client discussions right now. I mean, it's the phone doesn't ring off the hook anymore. It's just your email blows up. So it's like every day the email's blowing up. And our pipeline growth is actually 50% in the past 6 months. So what is coming in, as I've talked to the SEEIT team at the top of the funnel, is just kind of blown up since the Inflation Reduction Act. We've got really great go-to-market strategies. As I just mentioned, it's direct to customer. We are working with the military on a number of military bases as we speak. The Department of Defense has a huge mandate. Of course, we continue to do RFPs, and we get a ton of referrals. We'll talk about the other CEOs for the SEEIT here today. We've already talked about opportunities to work jointly together.
Okay. So we could probably talk a lot more about opportunities, but let's talk about challenges. Beth, what's really tested the business over the last 12, 18 months?
Talent and staffing. Everybody's understaffed. COVID is a big issue. People are still operating like they're in COVID. If you try to get something done in a utility, they're like, oh, well, we're on a hybrid schedule, that guy's out. So we still have that issue. We still have supply chain issues. If you want to get a transformer, it's 30 weeks. Sometimes we can't find inverters. It's the balance of system things. We've done a great job on our procurement for our solar panels, thinking, we're never going to have a problem finding an inverter or a connector. You'll be amazed. Like even something as simple as finding a replacement for a connector is a problem. So again, staffing, time lag, permitting issues with the utilities, with all kinds of governments and supply chain.
So what are you and the team doing to deal with these challenges?
We are riding every single wave, as I tell my team. I'm like, don't go out there if you're surfing, every single wave in. So we've really nailed down our procurement plan. We're already thinking ahead for 2024 in terms of solar. We've got all the solar panels we need for this year, but we're already thinking ahead to next year. We are, continuing to build our pipeline, as I mentioned. Kind of those. We really don't have a problem. We've got so many customers, we can't get back to them. So that's just ongoing. And I would say the other thing that we really have to focus on, as an industry, is talent. I hired a fantastic person to lead our commercial operations. She has been in the space for 20, 30 years. And it's really, we're in a nascent industry. It's very nascent. And so the talent is really important to make sure you've got that senior executive team surrounding all of the other people that you're guiding and making sure they know what to do and when to do it.
Fantastic. And so it's a nice segue to Paul. Mary Beth's talked about opportunities and challenges just now. What role does SDCL play in supporting, not Mary Beth, both in sort of dealing with the headwinds and tailwinds?
Certainly. Holistically, our asset management approach is to support management teams in meeting the strategic objectives of each SEEIT business. The asset management team members sit on the boards of these businesses to support this. We review and manage risk and support sustainable growth that exceeds our investment objectives. The board provides input and guidance on Onyx's growth strategy, both organically through pipeline development as well as through mergers and acquisition opportunities, to prioritize which growth opportunities they need to focus on. We also look at managing risk and supporting the successful operations of the businesses, as well as in other areas, including health and safety and governance. Onyx is currently working with other SEEIT portfolio companies to identify solar and storage opportunities at their sites. This provides Onyx with even more customer opportunities to support growth in the development pipeline.
Thank you, Paul. So I've been told I've only got a couple of minutes left, or we have. So this is the last question I'm going to ask in the formal Q&A session. It's one I'm going to be asking each of the panels, which is, what does success look like? What do you want Onyx to be doing, or how should it look in 5 years' time? And Jonathan, I'm going to start with you.
Three things, really. First of all, is make sure that it's a top 2 or 3 player in the United States. It's got everything that it should have in terms of strategy, team, capital behind it. The second thing is really measured output. That is megawatts. Megawatts of new on-site generation that we can install at our client base. And I think the third is strategic, which is not only having the benefit of this pipeline of projects for SEEIT at the project level, but also creating in Onyx an even more valuable platform as an enterprise, and that I think can has the potential to create some very significant value for SEEIT, as well as obviously its customers.
Mm-hmm. Mary Beth, do you want to add anything to that?
I think Jonathan did a fantastic job. It's like that's everything I want. I think about it in terms of a dog year. A dog year is 7 human years, so I think about 2030, and I talk to this with my team. We have 1 dog year. We're going to be the leading player in the United States. I'm going to put out a number so somebody could probably kick me under the table. I want us to be 75 to 100 megawatt run rate at the end of this decade, so that every year we're doing 100 megawatt clip of activity. And I think that is something that can easily happen with the growth in this space.
Brilliant. Well, thank you to the panel. I think we've got some time now for some Q&A, and I'm going to start off with the audience here. There is a microphone. Anjali's got it. Please, if there's anyone in the audience who would like to ask a question, please raise your hand very high, because I haven't got my glasses on. Anjali, there's a lady back there.
Hi. Yes, hello, this is Monica Tepes from ThinkCap. Thinking of your company from an investor's perspective, you're investors in them, investors in the fund are. So can you talk to us in terms of return? So you talked about your objectives to be the largest or the top two, but financial-wise, in terms of the returns that comes back to investors, how do you think of that, and what's your place, sort of what you expect from this investment? How long do you intend to hold it? Is there a benefit that comes from scale, or is it that you just generate returns and there will be, or is it that when you get big, we're gonna sell, gonna make a huge profit? So just trying to understand the return rationale of the investment.
Brilliant. I think that's a great question for you, Jonathan.
Yeah, and then I'll hand off to Mary Beth. But so SEEIT's investment objectives are a 7 to 8% IRR from its IPO share price of 100p. So every time we make an investment, we want to make sure that we can underwrite to at least that level of total return. Obviously, we're currently in a relatively high interest rate and inflationary environment, so we factor that into any new investments. I would say that 2023, from that perspective, is a very good time to be investing in projects for the credit quality that we are looking for. So that's the first sort of threshold answer to your question. And that's at project level. In addition to that, and one of the sort of opportunities I think we have with Onyx is to generate not just project level returns that meet or exceed those hurdle rates, but also enterprise value in the platform. As I said, we currently own 50% of the development engine that sits behind Onyx. So I think in addition to the fundamental, if you like, intrinsic value of the project investments over time, we're really looking to help build out this machinery, which I think could be valued well by the market. And we're certainly seeing quite a lot of M&A activity at the moment in and around solar developers, like Onyx, obviously not as good, Mary Beth, but very high quality developers that are well sought after and highly valued in the market. So that would be really what success looks like for us. It's meeting the core project returns, exceeding them, and then generating additional total return around that.
Oh, there's another question at the back.
Nigel Hawkins, Hardman & Co. Two questions, if I may. First, can you distinguish Onyx from another quoted renewable energy player, US Solar, which is effectively up for sale? We'll know in the next few weeks exactly what position is on that. They have cited adverse industry reasons and problems for that decision. I wonder to what extent you are affected or totally different. And secondly, one I guess for Dr. Maxwell, you're presumably trading quite profitably. I just wonder whether you could share an EBITDA number with us.
Okay, so just I'll answer the first half of the first question and then invite Mary Beth to do that. Recognising that US Solar Fund, I think you're referring to, which is a London Stock Exchange listed company, is a public company, and I won't make comments on its current situation other than to say that its business model fundamentally is different. And the fundamental difference is that it's investing in utility grid-connected investments. That is, the business model is to build typically ground-mounted projects connected into the utility grid, whereas the projects that Mary Beth and Onyx are developing and investing in are connected directly to the end user rather than to the grid. So it's really a very fundamentally different approach. The returns that we generate at Onyx through our project investments correlate exactly with the returns through the power purchase agreement that we can enter into directly with the end customers, not via the grid. So fundamentally, it's a different business model, it has a different financial structure, and it has a very different growth trajectory and competitive set and framework that operates around it. Ultimately, we're solving problems for customers. We're not supplying energy to the grid. And that problem solving for customers is an incredibly valuable outcome, both for us and for the clients. But maybe I'll come back to the second question in a second. On the second half of the first question, what makes us different from grid-connected renewables like solar, US Solar?
It's as you said, it's a tremendous difference. So I've operated in utility scale, and utility scale, there is, the U.S. has something called IRPs, Integrated Resource Plans. Every single utility has an integrated resource plan. They have historically developed these, put them on a shelf for a dog year, and not gone back and looked at them for 7 to 10 years. What needs to happen in the U.S. is that needs to be revisited quite a bit more often. PJM, which is one of the largest RTOs, or regional transmission operators in the United States, they have more or less crucified their confidence with all market participants because of what's happened in the last auction. The people submitted bids, and then they said, oh, after we've looked at these bids, no, we're not going to accept any. We're going to go back out. So there's a lot of issues with every single ISO, independent system operator, RTO, regional transmission operator, in terms of how the bidding for capacity works. And it's taking a very long time. So there's no utility scale going and getting connected into PJM for probably 5 years. So I don't know all of their projects, but it's a huge issue. And the margins on that business are razor thin. The margins in our business are very healthy, and they're very healthy because we provide a service. We're providing a service to the customer. We're maintaining the asset for them for 25 years. We are, giving them economic savings against a utility rate. So we're providing them a fixed rate cost, and they're fluctuating with the utility. And utility rates, by the way, are never coming down. That I will go on the record for like 50 years. They are never coming down.
Did you want to answer the
Yeah, I think in your question on profitability, can I just clarify? Are you referring to SEEIT or Onyx? On Onyx, yeah. I think we will be producing a set of KPIs and outcomes in our annual reporting, which is due. So we're a couple of weeks away from the financial year end. What I would say is that obviously we disclose and we publish the profitability, the EBIT on the portfolio as a whole, and Onyx is making its pro rata contribution to that. But we will be publishing specific KPIs around our individual portfolio companies, and we'll be picking up, I think, your question within that context.
Okay. So we've got time for a very, very quick question if anyone wants to relate. It's quick.
Thank you. Yeah, I'll try to be quick. Luke Hyde-Smith, Waverton. So could you just detail current operating megawatts of power and what the pipeline looks like relative to that? And second one, if I may, just detail what a PPA looks like. What sort of contract does it look like? I know you mentioned 20, 25 years, but just give us an example of what a typical contract looks like.
So our average, in terms of, it's 20 or 25 years. I would say on average over the portfolio, the price is probably, call it 110 megawatt per megawatt hour. In terms of across the portfolio, if I think about averaging, everything, 11 cents a kWh, 110 per megawatt hour, is kind of where that is. In terms of the operating portfolio, I don't know, Jonathan, do you want to talk? Because we manage almost 200 megawatts of projects, but there's a difference.
Yeah, so as I said, we own 50% of the Onyx platform, which operates, as you say, over 200 megawatts. In terms of the owned assets within the existing portfolio that are operational, that number changes because there are assets that go from construction into operation, but that will be included in the reporting cycle that we disclose at the end of based on where we are at the end of the month. But if you have a look at giving a sort of indication, Purvi, of where we stand, just to be helpful within the context of the value that Onyx represents in our portfolio, there are three components to that value fundamentally: a portfolio under operation, a portfolio under construction, and the development assets. And probably the largest part of the value is the value under construction. Second is the value under operation, and the third is the development pipeline. But we'll give you the breakdown where it stands today as part of the reporting cycle.
Right, I've been duly informed that we've run out of time, so apologies to those who didn't get a chance to ask their questions, but we will follow up. but I'd like to thank the Onyx panel for their time.
So thank you again to the Onyx panelists and those in attendance for your questions as well. So moving on to our next panel, we have SEEIT Oliver, a cogeneration portfolio of projects servicing the olive industry located in Spain. Following this panel, we'll have a short 15-minute break as a reward for making it this far. Please could the SEEIT Oliver panelists join the stage as we play our introductory video for this asset.
My name is Luis Fontecha. I'm the Managing Director of SEEIT Oliver. We run plants in the olive oil industry here in Andalusia. Andalusia is the largest producer in the world of olive oil. We acquired the asset in November 2019. The portfolio comprises of 2 integrated plants where you will find cogeneration, an olive oil plant, and a biomass plant producing electricity, which we'll sell to the grid. Plus, we have cogenerations embedded in other plants for the olive oil producers. Cogeneration is bringing 2 procedures. One of them is producing electricity, and the other one is producing thermal energy. We produce electricity on cogeneration of around 750 gigawatts a year. The olive will go into what we know as an extra virgin olive oil factory. That will only take 10% of the product. The other 90% is a waste called olive pomage. That is full of humidity. We use the thermal output to dry the olive pomage. When that is dried, we will take it into an extraction system, and we produce orujo olive oil and olive cake, which is a biomass. The olive cake will go into a biomass plant to produce electricity. Nowadays, we are very conscious with the environment. We do that in 2 ways. First, we solve the issue of waste, as the olive pomage is not dumped into the environment. And at the same time, we are very efficient with the energy we use for the process. If you were having 2 separate processes, you will use 36% more energy to produce the same output.
Excellent. So I'd like to welcome the Oliver panel. With us today, we've got, from the far side, we have Eugene Kinghorn, CFO of SDCL, Luis Fontecha, MD of SEEIT Oliver, and Ben Griffiths, Director in our asset management team and responsible for our European investments. So Ben, I'm going to start off with you. It'd be really helpful to the audience if you can talk through how the Oliver projects work.
Yeah, so I'll just start by noting I am biased, but as an engineer, I think this portfolio is a truly brilliant portfolio of assets. They're large-scale energy efficiency assets, total in capacity of 125 megawatts, delivering a real solution to a real problem in the industry. So what it involves, we've got 9 operating assets spread across 5 operational sites over the south of Spain. And what the assets are doing are delivering on-site efficient heat to olive oil processing plants. And without that, those plants, those processes couldn't operate economically and therefore sustainably. What we do, we use natural gas to produce that heat through cogeneration assets, deliver it to the olive oil processing plants that uses that heat to dry the olives and then to extract the olive oil. Also, what the portfolio of assets do is utilise the waste byproduct from that process in order to produce renewable power through biomass assets.
Thanks, Ben. So I think we've heard the word olive said quite a few times. So it'd be really helpful if you can explain the importance of these projects to the local economy.
Yeah, and Luis and I can fight afterwards about who gets to talk about olives and bore everyone in the over drinks. But the Oliver portfolio consists of some of the most highly efficient cogeneration assets in Spain. In doing so, it provides critical energy infrastructure and services to some of the largest olive processing plants in the world, including the largest in the world. And also, what the heat that is produced by the cogeneration assets, that's also replacing old and outdated technology that used to be utilised, which was also very harmful to the environment. So what we've got not only is a set of assets that are delivering efficient, clean and cheaper energy, but they're also contributing to the circular economy and therefore reducing the impact on the environment.
So Ben, what makes these assets a good fit within the SEEIT portfolio?
Yeah, so there's a really good fit with SEEIT because of the long-term contracted revenues across the portfolio, largely through the sale of the heat and the power. Also, these assets operate under something called the RO regime in Spain, and that regime looks to effectively mitigate any exposure that the assets have to commodity prices over the medium to the long term. So what we've got is pretty good visibility on the cost basis of these assets. Also, as we'll touch on later and give a little bit more flavour to, we believe that there's really good upside opportunity across this portfolio. We're looking to leverage the land, the space that we have on site, look at installing, increasing capacities of the plants, and also investing in other technologies in order to drive EBITDA performance over the near term.
Thanks, Ben. So, Luis, you joined Oliver in January 2020, a few months after SEEIT acquired the assets, and I think employee number one.
Correct, yeah.
So, could you talk through your background before you joined Oliver, and also what are the areas of focus that you have in your day job today?
I mean, I'm an economist by trade. I've been the last 15 years running companies in the energy sector for investment funds like this one. And probably my knowledge is, I would say, the only energies I haven't touched are the traditional ones like coal or nuclear or something like that. So I would say I understand all the technologies, renewables that we have. This is the first time we are moving to the energy efficiency side, which is not producing but consuming and doing it in the most efficient way. What I do in Oliver right now is I look after the strategic day-to-day of the operation. We oversee the subcontractor, the O&M subcontractor. We have as well set up a small platform, 15 people. Bearing in mind that what we have done is create departments that brings value added that the portfolio didn't have in the past. So quite proud of this particular part of the story.
Brilliant. And so, Luis, when you talk about managing sort of the day-to-day operations, it'd be good to talk about some of the challenges you've faced,
Sure.
particularly over the last 12 months. Can you provide a bit of colour around that?
Yeah, sure. It's been a challenging time, we have to confess. Technically, the portfolio, those assets are very good, very strong. They've been performing quite well, even under the COVID lockdown. So even with logistic problems, we have done pretty well. We may say that the hiccup came from the regulatory side. As Ben was mentioning, on the subsidy side, we have the RORI regime. And basically what it does is it calculates the electricity pricing, your revenues and your OPEX as gas and CO2 emission rights. And the government will supplement that so you can feel you are on a break-even or above. This is the part of the contracted revenues concept that we use in the fund. So I would say that is what it has created such a cash flow problems we've been facing.
Yeah, so they've not been updated in a timely manner.
Correct,
That's
yeah.
Right. And so, in light of these external factors, what have you, and you mentioned you've got a team of 15, what have you been doing to manage this short-term issue?
We've been very strong on lobbying at all levels with national, local, regional governments. We've been talking to all the stakeholders, the association, so we've been really pushing to have this regulatory update that was supposed to be part of the story. Beyond that, what we have done is leveraging on the departments that we created when we acquired the assets. We've been running the best of our abilities to not have these cash flow problems. A clear example is we have a gas procurement company, so we have managed to do very well with that one. And at the same time, we do hedging, and that is helping us with the risk management part of the story.
It's all been about managing the sequence of operations
Yes.
and managing the cash flows. So thanks, Louise. So taking that area of cash flow, it's a nice segue to ask Eugene a question on cash flows, and then particularly, could you talk through Oliver's capital structure and why it's appropriate for the business?
Yeah, thanks, Bobby. Yeah, we currently operate with a very efficient capital structure in Oliver. Ben told us there are 9 assets. Of those, we own 100% of 8 of those assets, 90% of the remaining asset alongside the off-taker is the co-shareholder there. So at the time of acquisition in 2019, we actually made the decision for Oliver to pay down its significant level of project-level debt that it had at the time. And the predominant reason for that was to give control and flexibility, manage the downsides, but also give us the flexibility to look for the upside growth opportunities. So by operating on an unlevered basis, Louise and his team can really have full control and that flexibility that they require to, as I said, to manage the downsides, but it makes the growth opportunities more attainable as well. We do keep the option open of putting some leverage back into this set of assets based on the fact that it has previously been levered, so it is it's bankable, as they say, and there's strong underlying performance of these assets. As it stands, we feel it's the most capital efficiency that we have for these assets.
Okay, brilliant. Thank you, Eugene. And so, Louise, you've talked about how you manage the operations and sequence to manage this external impact. But one thing you said in your answer, and an area that you said you're proud of, is some of the operations that you've created, or the value you've created. And you mentioned gas procurement. And you've talked about you bringing it in-house. That's some of the words you used. So can we lift the lid on that a little bit more? How did that come about? Like, what was your thinking? Why is it created? And what, in particular, how is it creating value for Oliver and ultimately SEEIT shareholders?
Yeah, when we acquired the asset, we realized how huge our gas OPEX line was. So we thought, why don't we, instead of having a standard contract with a utility, why don't we bring that in? So we will, first of all, get the margin that the utility has. Secondly, you will have flexibility in how much and when you buy your gas. So that will give you another independent way of running the asset. And lastly, we have the capability now of storing gas. So we can buy gas at a cheap price and use it when the time comes. Or the other way around, if we have any issues with any asset and it has to shut down, we can still, have that gas if the price is right. Okay.
Yeah. So it sounds like it's all about being able to be flexible in your operations and managing the downside risk. Sounds like a great attribute to have. So I'm going to come on to our last question. Same question I've asked the last panel, so you know what it is, which is, what's the vision for Oliver in 5 years' time? What does success look like? And so I'll start with you, Ben, and then Louise, if you could add in your answers, that would be great.
Yeah, so I think fundamentally, obviously, Louise mentioned that last year was pretty challenging with the RO regime, but now that's largely resolved, what we're looking to do is really get back to focusing and delivering on growth. We keep on talking about growth and growth opportunities. There are plenty on this portfolio, and both sides of the P&L effectively. So, we believe there's strong opportunities in terms of cost reduction across the portfolio, whether it's utilising biomethane potential there or deploying carbon capture technology across the portfolio, essentially to reduce our emission costs across the assets. Also, I mentioned the land previously. We own a lot of the land and there's a lot of space on that land. We're really looking to leverage that looking at potentially expanding some of the capacity of certain areas of the plants in order to boost the capacity and the throughput, but also looking at opportunities to make hybrid investments into other technologies, for example, PV solar installations on site, in order to produce and become more self-sufficient in terms of consumption of electricity on site that will reduce our cost basis. So effectively what we're looking to do is to really drive our EBITDA margin. There's a lot of potential out there, and we're looking to progress a lot of these and ultimately deliver more EBITDA over the next 3 to 5 years.
Luis, anything to add?
Okay, not much to that one. Probably I would say that one of the things we're doing is we have managed to set up a very reputable platform in Spain. We are recognized like a very efficient, one of the energy efficient platforms in Spain. We are a top player in the olive oil industry. We are a top player in cogeneration and biomass. So we can leverage on that to buy other investments and by economies of scales increase our margin. Beyond that, when you have things like, for example, the gas procurement company, the whole idea of biogas or any kind of fuel or biofuel, you can either create that biofuel or you can resell it. So we have the possibility of decreasing our OPEX by being there in the market. Okay.
Thank you both for that answer. So this concludes the formal Q&A. Again, the mic will be making an appearance. So yes, I think we've got a question here at the front.
What is the typical temperature range that you're recovering heat from? Is it low or high?
The recovery on the thermal, you mean? Well, you have high and low, okay? You might be on drying side, you're on 350 degrees, the exhaust of a gas turbine, although we use as well gas engines. And as well we use a lower temperature in other, as we try to be efficient in other part of the plant, we use something more on the region of 180.
And have you come across a product called Thermal XP from GMG Graphene?
Yes, we have, but we still believe it's not a tested technology that we can utilize at this point in time.
They've not convinced you yet?
No.
Are there any other questions? There's one. Run. Purposely choosing ones from different sides of the room.
Great, thank you. Tom Pocock, Peel Hunt. Could you just give a bit of clarity on how the sort of valuations or maybe revenues are split between the biogeneration part of the business and the sort of cogeneration side? And on the biogeneration side, is that energy going to the olive oil producers or is that just going straight back into the grid? How does that work?
Okay, I mean, we operate under the circular economy. So what we do is the cogeneration will produce electricity, the thermal output, the exhaust, will go into the olive oil plant. It will dry this idea of the olive pomace. So they're quite intertwined. So there's a lot of dependency on this side. The leftover, you produce the olive oil in the olive plant, and the leftover will go into the biomass. So depending on productions on one side and efficiencies on one part of the process, you will have on the other side. The biomass will burn the olive cake and will produce electricity. So it's a complete circular economy. Nothing goes to waste. Okay. So coming back to your question, it depends how efficient one part of the story is to create the other one. The first one is cogeneration, and we are one of the most efficient in the industry. But I couldn't tell you how much is biogeneration and cogeneration depending on that.
I think, Eugene, if you want to talk about, sort of provide a bit more detail around how our approach in terms of the valuation.
Yeah, look, I'm going to start from the little end, which is that the olive oil sales itself is a byproduct for us. So it's not actually about that, although we're very much in the olive industry. And then the larger components of the total revenues, which would be on the CHP side, I'm trying to estimate it quick in the top of my head, but 50 to 60% from the CHP and then the balance from the biomass.
But perhaps we could say we are an electricity producer more than anything. That is our largest revenue stream.
But is there any more questions? Oh, we've got another one here.
Nigel Hawkins, Hardman & Co. Could I just ask about the RO pricing regime issue?
Yeah.
First, do you consider it simply a blip, it won't recur? And secondly, I think one of your colleagues mentioned it was largely resolved. I'm just wondering whether you could elaborate as to what largely means.
So, I think I will direct that to both Ben and Luis. If you can both cover that, that would be great.
Yeah, so, I mean, in terms of the first part of the question, in terms of whether it's a blip, I mean, we certainly hope so. I think what last year should have done is highlighted the issue that it causes within the industry. So, you know, there were significant issues caused by the lack of the updates coming through to that regime. That was the problem. The intent remains the same, and what should happen remains the same. So, you know, we're confident that it shouldn't happen again, and the circumstances that we saw last year, you know, are a one-off. But what I would say, you know, just to kind of try and flip that on the head, is that Luis is one of the more modest people that I know, and the team that he's built in Madrid and the gas procurement team put us in a different category to anyone else in the industry in terms of being able to deal with that situation. So, you know, hindsight's a really wonderful thing, but we have looked back in hindsight, and actually the conclusion was that we did exactly what we should have done, and the situation was managed as best as possible. There's lots of other people within the industry not in great shape. So, yeah, I think, will it happen again? We certainly hope not. The impact on the whole cogeneration industry in Spain, and more importantly, their off-takers, their customers, was pretty profound. And you may be able to shed some light in terms of numbers, but you know, that should really, that has woken the industry up to the problem, and is really the narrative in terms of ensuring that it doesn't happen again.
Yeah. Perhaps adding to this, I think one of the issues has been with the crisis we have faced, doing these numbers that the government is supposed to do to calculate the RO has been tremendously difficult. Okay, so that, from my perspective, has been a large part of the delay in having the RO. What has happened in the energy sector, we all know here, will it happen again? As we said, well, we have seen the professor on the first interview. It's the first crisis, and most likely it will not happen within the next 30, 40 years again. So I don't see that the conditions for what has happened will happen again in the near to medium term.
Okay.
I hope it answers your question.
Thank you. Brilliant. I'm just conscious I didn't let anyone online ask a question last time, so I just want to check if there is anyone from online. If not, that's fine.
Hi, so there is one question online. It'd be great if you could talk a little bit about the competitive landscape that you're experiencing for Oliver.
Okay, we are a player in different industries. We're a player in the olive oil industry, okay, which is the largest producer in the world, this part of Spain. So we are a top player there. The olive oil industry, because of raw materials, is gone up. That will give us, a lever as far as, revenue increase. In the cogeneration, I think we have managed extremely well the whole idea of the gas, something that not many people have done. I think the idea of having a whole department trying to foresee where the gas was going has helped in a very, very good way. Okay. And the biomass, which is perhaps is one of the markets that it seems like will grow because of what the government wants to do, is another of the areas where we are very strong. So what I'm trying to say is that we have come out of a very difficult time in a very good shape, okay? Something that not many players can say. So it's only a matter of for us to grasp the opportunity to grow and increase our EBITDA.
Brilliant. Well, I think we have timed out. So again, apologies if you did have a question. We will collect them. And I'll just pass over to Tom. But I'd like to first thank the panel for Oliver for answering those questions.
So as promised, we'll take a quick break now. Those of you in person are welcome to grab a tea or coffee outside and bring them back to your seats before we begin the next session. Those who've joined us virtually, please bear with us. We look forward to commencing the next panel in about 15 minutes. Thank you. Okay, welcome back, everyone. So for our next panel, we have Primary Energy, a US-based portfolio of recycled energy and cogeneration projects. As you can see, our panels managed to find their way to the stage. So if we could play the introductory video for this asset, we'll get going shortly.
Mo Kleffiker, president of Primary Energy. I have 30 plus years of experience in the energy sector here in the U.S. Primary Energy consists of 5 projects. Clean energy is produced utilizing waste energy from 2 major steel mills. One is Cleveland Cliffs. They own the Indiana Harbor Mill, where 4 of our projects are located. 2 of them utilize blast furnace gas. The blast furnace gas is reused in a boiler, produces steam, and that goes to 2 of our projects, North Lake and Ironside. Our 3rd project is called Coke Energy. That utilizes waste heat. The heat is collected from 268 coke ovens, is then put into a heat recovery boiler. Steam and electricity are produced, which is utilized by the steel mill. So there's no fuel involved. Our other project over at U.S. Steel is Portside. It utilizes natural gas. It produces steam and electricity. We also produce all the water products needed by the Midwest facility. One of the biggest benefits that Primary has in its relationship, it's really its partnership with the steel mills. We provide the management. We obviously own and operate the facilities, but the operators, they are steel mill employees. So the sort of the benefit that we have provided to the steel mills over the years is we utilize their employees. The business plan for Primary Energy is really built around long-term contracts. The benefit of our contract is really the stability of the cash flow coming into our business. We are the big E in ESG because of the efficiency, but also because of the environmental benefits. We reduce the CO2 emissions because we're utilizing waste energy. And if you think we're behind a meter, we're integrated right into the mill. As far as delivery of that energy, it doesn't get any more efficient because we're on site. The one thing that we tend to follow with both steel mills, U.S. Steel and Cleveland Cliffs, is their sustainability goals. We have identified a couple of opportunities looking at new technology associated not just with efficiency, but also in CO2 reduction.
Right, so panel number 3. I'd like to introduce the panel. We have Mo Kleffiker, President CEO of Primary Energy, and Jonathan Maxwell, who I'm sure doesn't need a third introduction. So I'll start with Mo. I'll start with you. Can you tell us about your background and how long you've been at Primary Energy?
Sure. Thanks, Purvi. As you can see in the video, I mentioned I had 30 plus years of experience, both in the utility and non-utility, as far as operations in the energy industry. I started when I got out of school working for NIPSCO, which is the local utility there in Northwest Indiana.
little background, it's also where Primary Energy started as a non-regulated business with Primary Energy. But I primarily worked in the electric production, plant engineering, and really understanding utility operations. Throughout my career, I continued to take on new opportunities, and I have about 20 years of executive management experience, both with Black Hills Corporation, Southwest Generation, and obviously with Primary Energy. I started at Primary Energy as the CEO and president back in 2015, and happily I made the transition over when SDCL SEEIT closed the taking over 100% ownership at the end of September of 2021.
Thanks for talking through your background. Like with all the other panels, I think it'd be really helpful for the audience if you could talk through how the primary energy assets actually work.
Sure.
And in particular, Mo, if you could talk through how they support the steel-making process as well.
Sure. I think first I'll talk about the portfolio, and then I'll kind of do an overview of the integrated steelmaking that we have. Primary Energy, again, is a portfolio of 5 projects. They're critical, essential assets. We are located at 2 major steel mills in Northwest Indiana, U.S. Steel and Cleveland Cliffs. As I look at our assets, it's really about energy transformation. We have 300 megawatts of approximately capacity. All of our facilities are behind the meter. And so we rely 100% on the steel mill's activities to produce the energy that we can transform into energy and electricity and steam that we deliver right back to the steel mills. And as I kind of mentioned, it doesn't get any more efficient than that as far as our on-site location and the way we deliver it. I kind of just now wanted to sort of give a high level so it'll add to my discussions as I talk about our individual assets, but integrated steelmaking. So I'll start it, obviously at the end steel is produced, and I kind of work my way back from steel. It's obviously you need iron, and in order to have iron, you need to have a blast furnace. And what the steel mill does is they input into a blast furnace iron ore, natural gas, coke, and in the case of what we see with Cleveland Cliffs, they utilize metallurgical coal. All that's injected into a furnace and iron is produced. Once the iron is produced, it goes over to what we call a basic oxygen furnace. From there, we are basically, the steel mill is transforming an element, iron, to steel, which is an alloy. From there, it goes to the rolling mills, and coils are then produced as a product that's made from the steel mills that are either shipped to other plants for further processing. So again, just to reiterate, Primary Energy doesn't own any of the steelmaking equipment or any of the facilities. Again, we just want their waste energy. That's what it's about for Primary Energy. So with that, that's kind of how we're connected into the steelmaking process, both at Cliffs and U.S. Steel.
Thank you, Mo. And with these the facilities and how integrated they are, how do you actually manage them? And in particular, what's your team look like? What do they do?
Sure. At Primary Energy, we have really 25 full-time employees. They provide both the operational and management of our assets, but in addition, we also have corporate services, which provides all of the sort of services back to our facilities. And part of the corporate services is kind of HR, accounting and finance, engineering, and also environmental health and safety. And probably the other function we do is we also market RECs. RECs, renewable energy credits, are produced at 2 of our facilities, both voluntary and what we call compliance RECs. And we market those RECs to support the RPS, or Renewable Portfolio Standard, in certain states, primarily Ohio and Indiana.
Brilliant, thanks, Mo. And so You've alluded to some of the points there, but can you just bring together what makes primary energy so unique?
Sure.
Not just for the steel sector, but it sounds like for any sector, really.
Sure. Again, with the investment that was made into our 5 projects, it's very hard, almost impossible to duplicate. And so the operations of a steel mill is around the clock. And we are, again, as I mentioned, tied to 2 blast furnaces. At Cleveland Cliffs, there's 2 blast furnaces at what we call Indiana Harbor East and West. And then at U.S. Steel, we're tied to the U.S. Steel Gary Works facility, which has 4 blast furnaces. And from there, we have number 7 blast furnace at Cleveland Cliffs. It is the most efficient and largest blast furnace in North America. So it is a tier 1 resource. At U.S. Steel Gary Works, they have 4 blast furnaces, as I mentioned. Number 14 is their best. Again, it's a tier 1 resource based on performance and efficiency. And I guess just an example, in the U.S., when we shut down the economy during COVID, number 14 and number 7 did not shut down. So when people ask me about a stress test, I don't think you'll get a better stress test than that in the production of steel related to those 2 steel mills.
Brilliant. So Jonathan, Mo's talked about sort of the key characteristics of primary energy and its criticality. What is about those characteristics that make it an attractive investment for SEEIT?
I think strategically, clearly, I think a great example of on-site generation, creating really high levels of efficiency, producing steam, electricity, and other services. So, strategically, great fit within the portfolio. Financially, we look for contracted cash flows, and we have within the primary energy portfolio fundamentally is a contracted cash flow based portfolio. We've got 2 different types of contract in there. One which is so to speak, largely availability based. That is, we get paid to be available for use for the steel mills, and then we have for the smaller part of the portfolio a capacity based contracting approach where we're effectively the first dispatch or the right of first dispatch to the steel mill. So sort of high quality cash flows. Second point is sort of alluding to Mo's point, and this is hugely important for us. We're essential. What we look for in SEEIT's portfolio are opportunities to be an essential or critical energy service to essential or critical industry. It's a really important part of the role and credit story behind our projects. So in this case, very pleased to be attached to a couple of the most important blast furnaces in America. Third point is environmental. So I think that just to sort of recap, we're generating about 298 megawatts of energy. It has such a high benefit, environmental attribute associated with the energy that we're creating through recycling what would otherwise be waste or polluting energy. That if you compared it to wind and solar, for example, it's got the renewable energy certificates we get would be equivalent to over 500 megawatts of solar or about 400 megawatts of wind. So it has a tremendously significant environmental attribute and benefit. So probably those are the main points. I think we obviously, as a long-term owner of assets, projects like this, we also like the opportunity to continue to provide these sorts of services to really high-quality clients and infrastructure assets. And fundamentally, there's a continuity and an extension of life, which can provide additional value to us as an investor.
Brilliant. And one area around sort of the investment characteristics that I'd like to talk in a bit more detail is about the credit story. So can you talk us through that one for primary energy?
Yeah, I mean, going back to my point, Purvi, about why we like this portfolio. A few points. When we first made the acquisition, these blast furnaces. In fact, 4 of the 5 projects that we are invested in the primary energy portfolio were servicing ArcelorMittal USA. In fact, still are. It was just acquired by Cleveland Cliffs. So when we first made the investment, we had an investment grade counterparty. Cleveland Cliffs is one of the fastest growing, best steel companies in the United States. We're very pleased that they're good owners of these underlying assets. But one of the features we look at when we make any investment is the credit standing of the existing owners, but also going back to this point about being essential to essential counterparties. That's exactly what we are and who they are. Whoever owns these steel mills, the steel mills are needed in the United States, and the steel mills need us. So it provides us with a really solid foundation on which to continue to provide energy services.
Thank you, Jonathan.
The one thing I did want to add to what Jonathan's saying is really the long-term contracts that we have. As he mentioned, the key component is what we call first dispatch. And so if we're available, then they have to take our energy, both the electricity and steam that we provide. And so part of that is maintaining the highest availability and reliability for the benefit of providing these products to the steel mill. So again, that's always going to be a key component of our contracts is the first dispatch.
Yeah, absolutely. And just moving on to the criticality, you mentioned actually one of the stress tests, was during COVID, and 7 and 14 stayed on.
Sure.
But what other challenges have you seen, particularly during the time that SEEIT's been an owner? And how have you and your team been dealing with those?
Sure. One of the challenges that we've had is really due to the idling of number 4 blast furnace that affected the shutdown of, right now, temporary shutdown of our Ironside facility. To give you a little history, Cleveland Cliffs had operated 10 blast furnaces. They decided to idle 2 of them, one being in Dearborn, Michigan, the other one being at Indiana Harbor West, which was our Ironside facility. But like anything, we began to think about, okay, what do we do? One of the benefits that we immediately saw was we saw about half of the production off of number 4 go over to number 7, because there was that room of the available capacity on number 7 blast furnace. So we saw the pickup and benefit to 3 of our projects, which is PCI, Koch Energy, and Northlake. The other thing that we worked on, because our contract, even though our blast furnace was idled for Ironside, the contract was still in place. One of the provisions in that contract is we get day for day. So each day that Ironside is shut down, we get a day back on the back end of that contract, so we don't lose the remaining term of that contract. The other thing we were able to do is negotiate an interim agreement using the Ironside steam turbine. And so we went through the process of negotiating with the steel mill, and we were successful in completing that agreement, and we started up Ironside back the first week of February. So Ironside has been operating. We share in the efficiency and the cost savings, and it kind of goes to the theme, the reason why we can use Ironside, because it's more efficient than their choice of generation. And so with that, we feel very good about at least getting Ironside back on. And then we are exploring a couple other opportunities that would allow us to think of a different way to operate our Ironside facility. We're just analyzing that right now. So I think we think we've got some other ideas of how we can continue to operate our Ironside facility.
And I think that's a great example of the advantage of having such a skilled and experienced team on the ground working with the end user like Cleveland Cliffs to manage the downside. So thank you for talking us through that. And so I'm coming on to my final question, which you won't be surprised what I'm going to ask, which is, where would you like to see primary energy in the next 5 years? And in particular, Jonathan, what value is SEEIT seeking to achieve as an owner? So
I think to some extent in this case it's continuity. We we're deeply embedded in these steel mills. So if we can continue to provide a great service to our steel mill customers, we can continue to generate income and indeed look for opportunities, as we constantly do, and Mo's been very successful at doing this so far, to extend the life of those contracts, which extends the present value of them. I think the other feature of this issue is that I think, just to sort of recontextualise what Mo and Primary Energy are doing in the energy system, probably the largest component or contribution to greenhouse gas, the largest user of energy in combination, is steel, cement, chemicals and plastics. So these are the critical energy demand loads in the world. So this is really the biggest source of greenhouse gas emission reduction. So, but it takes time. It takes a lot of time and trust to be able to operate energy systems inside these critical facilities. And for me, that's really one of the areas that Primary Energy stands out, and with Mo's expertise. So what we're hoping to do is to take the benefit not just of that through extending the value of our projects at Primary Energy, but also to other sites for the customers.
And Mo, what's your dream?
Oh, yeah, with the way that I think about the next 5 years, obviously very focused on renewal of contracts, very important. Right now, we've started negotiations on a Koch Energy contract, and so far everything is moving forward. The other thing, we're off to obviously a good start for this year, so that's a positive. But as kind of Jonathan hit upon, it's kind of going back to our partnership. One of the things we do with our operations is kind of indicated in the video. We utilize the steel workers, and we have about 65 steelwork employees that we use to operate our facilities. And with that, obviously, it's allowed us to strengthen our partnership because of the use of those employees. When the assets first came online, we created those jobs for the steel mill employees, and more importantly, today we maintain them. But I think with that, we're looking at opportunities around energy efficiency. I think as kind of Mary Beth indicated, we're looking behind the meter for other opportunities, may include solar. Obviously, using Onyx and combining sort of the resources between Primary and Onyx would be a way that we could work together to look at those kind of opportunities. I still think there's a waste heat opportunity, as I call reducing the flare. And that is something else that we've just started to explore as we're talking today about. So I'm pretty excited about, I think, some of the opportunities that we have. And once we do get the contract renewed at Koch Energy, we obviously focus on enhancements. And I guess the example of that is kind of peeling back the onion, as they say. We're going to keep peeling back the onion and use the contract to find other opportunities to drive a higher return, and that's how we think we'll continue to be successful and obviously supporting the objectives here at SEEIT.
Brilliant, thank you. And I love that phrase about peeling back the onion. I'll be
Okay.
using that. So, brilliant. So I think we're very nicely on time to move to the floor for questions. And I will ask the audience first here before going online. If anyone's got any burning questions. Oh, got one here.
Hi there, Deepak Arora, MNG. Just a question around, as you think about asset life and the decarbonisation agenda, particularly in the US, where you've got the Inflation Reduction Act supporting some of that coming through, and the cement steel industry being a key focus area. How does that square with your assumptions around asset life and what your customers are wanting and the direction they're wanting to go into?
The thing about our assets is that, in order to continue to rely on them, especially the way that we do, you have to invest capital. And that's what we do in order to maintain the performance. And with steam turbines and the boilers and equipment like that, we feel very confident that we can continue to operate these assets under a long-term extension. And that's how we can continue to be comfortable with the performance that we would expect out of our facilities.
Jonathan, was there anything you wanted to add to that? Or?
Yeah, I mean, I think we're going to be. Well, the world's got a big problem, which is we need steel. We need steel for everything: wind, solar farms, cars, electric or otherwise. So, the question isn't whether or not to continue making steel, but it's how to make it with the lowest energy and carbon footprint and environmental footprint more generally. And I think what we're doing at Primary Energy actually has a great role to play. We're starting to see other mills around the world starting to employ similar technologies using waste gases, waste heat. And we actually have a lot of work underway at the moment looking at best available technology, even within our perimeter of our projects. So, what can we do to introduce technologies that will work to further reduce carbon footprint and resource consumption in the steelmaking industry? But steel isn't going away. In fact, if anything, it's growing all around us. But how can we, if we don't solve this problem, a bit like the other ones I was referring to at the beginning, then we're not going to get there.
The other thing that we look at is the investments made by the steel mill as well. And take, for example, number 7 blast furnace. As I indicated, 3 of our projects are tied to number 7. In September of 2021, they invested over $100 million in a reline of number 7 blast furnace. And that reline, I would expect, would get them another 12 to 15 years of operation. So again, we also see what the steel mills are doing by reinvesting themselves back into their facilities.
And Mo, I think it'd be fair to say you have very regular conversations with both US Steel and Cleveland-Cliffs about their decarbonisation strategy.
Yeah, I mean, that's one of the things that we have is the relationship, the partnership. But, we participate in a lot of the operating meetings with our plant staff. And it's just part of how we communicate, how we share and exchange information. One of the things that they really rely on us is kind of more or less our expertise of how we operate our equipment. Our approach to operating equipment is we want to take care of it. We have to because, as I indicated, it's got to be available, first dispatch. They, on the other hand, look at things a little bit differently. They think more about, obviously, making steel and less about energy. And that's kind of where I want to be is let us focus on energy, you focus on steel making. And that's the approach that we want to continue to have with the steel mills.
Brilliant, thank you. I think we've got a question in front.
Have you come across a company called 0 Point Energy, which has developed an axial flow steam engine to recover heat in the sort of mid-temperature range? They reckon 14 of their engines at a cost of £3.5 million can generate £5 million worth of electricity a year.
Okay, I'm not familiar where their operations is at.
Have a look, 0 Point Energy.
Okay, I will.
No one else? Tom, should we go to the online questions, see what's come up, if anything?
Thanks. One question from a retail investor. So how exposed are you to the steel industry and just the general ups and downs associated with steel?
We are dependent upon, obviously, the steel mill activity for, providing the energy that we need. How I look at the steel mills today, as I indicated, they're optimizing, number one. That's why we've seen them optimize their blast furnace production. But we also look at what they're doing as an industry. One of the things that they were able to get done under the previous administration is what we call Section 232. It's a tariff that protects U.S. produced steel. And this really protects the steel industry from dumping of steel from certain countries. That has also benefited, I believe, the operations of the steel mills. And I think the other thing is overall, we look at what industries they focus in today. Steel is used in a lot of different applications. One is the auto industry, and they do expect the auto industry in the U.S. to pick up. They expect a lot of pent-up demand to increase the auto sales coming out of the U.S. In addition, if you look at appliances and those type of household goods, again, they rely on that industry as well. And probably what we're seeing is just overall the use of steel in supporting the renewables. If you look at the transmission grid in the U.S., the steel needed for transmission towers. So we see a lot of applications continuing to be used in the U.S. for production of steel.
Brilliant. I think we might be timed out. If that's okay, we'll pick it up separately. But I'd like to thank the panel. Finished perfectly on time. And so, yeah, thank you, Mo. Thank you, Jonathan.
Great. So last, and by no means least, we have our RED Rochester panel. So RED is one of North America's largest district energy systems located in Rochester, New York. After the audience Q&A for this panel, Jonathan will join the stage for some closing remarks. I'd like to personally thank everyone for their attention today and for the tremendous engagement thus far in audience Q&A. So without further ado, please could I ask the RED panelists to join the stage as we play our introductory video for this asset.
Dan Kelly, I'm the Chief Executive Officer for RED Rochester. RED Rochester is one of the largest standalone campus-based district energy systems in North America, serving a mix of commercial, industrial, and manufacturing customers here on the Eastman Business Park. On campus, we are the utility and municipality for services. We have roughly 122 staff operating our systems. We have 47 buildings, so this equipment generating steam, electricity, chilled water, compressed air is distributed throughout the campus in various buildings and then interconnected by wires and pipes. The Eastman Business Park has a great history. So it got its start in 1891 when Kodak started manufacturing film and paper here on campus. RED provides the energy and other utility services here on the park, ranging from electricity, steam at 4 different pressure levels, chilled water at different temperature levels, compressed air, nitrogen. And one of the very unique features of the park is we have a water filtration plant on Lake Ontario, and then we pump that to the park and customers use it for process, industrial, and high purity water and manufacturing processes. In total, we can generate about 100 megawatts of electricity currently. Steam is around 1.4 million pounds per hour of steam. For chilled water, we're around 36,000 tons. We're just embarking on a project to install a new cogeneration plant, which will expand our electricity generation capacity to 140 megawatts. RED is blessed to have a great customer mix here on campus. We have roughly 107 customers, wide range of processes, and they're all under 20-year fixed utility service agreements. They are mostly investment grade or equivalent, very strong businesses, strong balance sheets. Energy efficiency is very important and core to our business here at RED. 2 of our core services, electricity and steam, we do this in a very efficient way. We've used natural gas in our boilers, produce high pressure steam, send that through extraction turbines where we're generating electricity. Then the byproduct of that is steam that goes out in our pipeline to our customers for process needs. So again, very efficient, 2 outputs for 1 input.
So I'm pleased to introduce our final panel. We have Sandeep Jain, who's Technical and Commercial Director in our asset management team at SDCL, Dan Kelly, CEO of RED Rochester, and John Behan, a Director in our investment team and also Board Director at RED. So welcome. Dan, let's kick off with you. Okay. Would you talk through what RED Rochester does? I know we've heard it in the video, but in a bit more detail, and also how it's organized.
Sure. So across the 1,200-acre Eastman Business Park in Rochester, New York, RED provides 16 different energy and utility services, ranging from steam, electricity, chilled water, compressed air, other water services I mentioned in the video, wastewater, to 107 customers, which actually is 120 buildings, ranging from manufacturing, medical devices, pharmaceutical, specialty chemicals is a big customer base for us, and then food and beverage as well. We do so very reliably and efficiently. So efficiently, that's our namesake. And as I said, all 20-year or more fixed contracts. Our customer base has a very high load profile, very consistent, so provides very consistent cash flows. And we have the benefit where we're exclusive to the business park. Any new customers that are looking to come to the park have to connect to our services. And another component of our 20-year agreements is the efficiency targets were set back in 2011. So any improvements we make with our efficiencies drop to the bottom line and benefit RED. We share that with the customers in a little bit, but we see the primary benefit. As I mentioned, RED has 122 employees. They take care of the day-to-day operations, maintenance, customer service, business development and growth, system optimization. We're always looking to improve and become more efficient, and project execution. So I feel like I have the luxury. I have a great team, very talented team, solid management team leading those efforts. And we have a great track record in delivering very reliable and efficient services and executing very complex projects.
Brilliant. Thank you, Dan, and thanks for talking through the background of RED. Let's talk about your background. You've recently joined RED, so a bit
January,
of a newbie.
yes.
January. What were you doing before RED?
So I've got, much like Mo, I've got 30-plus years of power generation and district energy experience. So on the power generation side, both regulated utilities, working with regulated utilities or independent power producers. And everything from planning and developing these projects to designing and constructing them to operating and maintaining or operating those systems. I did so in a wide range of industries, from commercial to industrial, pulp and paper, back when that was a business in the Northeast United States, healthcare, higher education, so a wide range. I focused a lot of that time on business development and growth and finding these opportunities, most specifically, at least in the last 10 years, district energy systems and building a strong network of contacts and other industry experts that I hope to utilize as we look to grow outside Eastman Business Park.
Brilliant. So Dan, why have we brought you on? Well, what's your objectives as CEO of RED?
So what I have two parts of my job. So the first part is focused on Eastman Business Park and growth on RED, focused on RED and the growth on Eastman Business Park, excuse me. So of the 1,200 acres I mentioned, 400 acres is open green space, so it's available for new businesses to come in. So we're working with the property owners, the landowners, the city of Rochester, the state of New York to find the right customers with high utility loads and services that would be the highest and best use of that available land. And then we'll work with them to, once they come on, we'll be able to connect them. And the existing customers are also vested in this because there's a benefit to them. The fixed cost portion of their bill will get lowered as new customers join and we expand our services. So there's a common goal there. So really we're working with those property owners and the city. The goal is to fill up all those open spaces and sell out of the RED services. I was
going to say, there's another
part of that beyond growth is the success of the capital projects that we already have on tap, and I think Sandeep will talk about a few of those that are going to deliver on the growth and efficiency improvements we see. So we'll meet and exceed those returns. And then the second part of my role is once we've sold out of the services, or as we're selling out of the services, starting to look beyond Eastman Business Park and finding the next RED Rochester, next system. So we'll look to expand in the Northeast, primarily upstate New York, New England, looking for other campus-based systems where we think we can differentiate ourselves and go after.
Brilliant. Thank you, Dan. And so, John, given what Dan said about RED Rochester, talk us through why this is an attractive investment for SEEIT.
Well, I think
you have to look at sort of what SEEIT's investment criteria is, and when we look at this asset, it really kind of delivers at the centre of what SEEIT does, which is providing highly efficient on-site generation and services directly to the end customer so that they can perform their business activities. And that's what we do. And as Dan mentioned, it's 16 services to over 100 different customers on site. And so then I think 2 years ago now, nearly since we underwrote the investment, I suppose what are the things that we thought were important when we were looking at the investment? And starting off, crucially, we had 20-year long-term contracted cash flows with customers. Any customer in the park was on a 20-year contract with extensions, and any new customer coming into the park also signs up to the same terms. And actually, when we looked at the customer base, we had sort of majority investment grade or investment grade equivalent as well. So, highly attractive when we were putting our first lens on the assets. I think a couple of the other things that were important were we actually liked the customer mix and the services they provided. So for a lot of customers, it's actually plug and play. So you come to the park, you plug in, and you're operating. And actually what that created was a really diverse mix of customers. Dan mentioned chemicals, technology, food and beverage manufacturing. And an interesting fact actually about that is that during the COVID-19 pandemic, we actually had more than 90% of those customers were flagged as critical industry. So actually the performance and variability across the portfolio was actually pretty stable. So again, to use Mo's point earlier, if you want to stress test, that's it. And look, finally, and probably got to go to the fun and exciting stuff since we're the last panel of the day, there was that word growth. And actually we found that the opportunities there to materially increase the value of RED, they were there. And the previous owner had done a pretty good job in getting the park where it was, but actually, I use the word unlocked. Actually, the park was kind of ready to be unlocked. And we were going to do that in, well, as Dan mentioned, there's hundreds of acres of available site and capacity. In fact, there was no marketing plan with Kodak. We're now addressing that. Secondly, we had tons of capital projects, actually at higher returns than we were underwriting. And I'm pleased to say that number's now doubled from 2 years ago when we were looking at it. The third was we saw a really good opportunity to put our other products and services from our other portfolio companies on the park. And I'm pleased to say we've had 2 or 3 portfolio companies already on site specifying technologies. And then, lastly, which is one of the main reasons I suppose, Dan was on board as well, is that we saw a great platform in the northeast of the US that you could then build out and grow from. So, that's why. And I'm pleased to kind of say that we're delivering on most of those.
Brilliant. Thank you, John. So, Sandeep, both John and Dan have talked about growth and opportunities, and in particular some CapEx projects. So can you talk us through the CapEx projects currently being contemplated, and in particular, if you can focus on how that brings value to RED and ultimately see its shareholders?
Sure, Purvi. So my role is to support Dan and his team on all the value accretive growth opportunities, and RED is a particularly interesting business for organic growth. And the reason is what Dan mentioned. We have a tariff structure that allows us to pass on all of the efficiency benefits directly to the EBITDA margin, and this results in really attractive returns for the business. And a good example of this is the cogen project that we are pursuing. This is a project where we are replacing some of the existing boilers and old steam turbines with a new cogeneration plant, which is going to generate power and electricity at much higher efficiencies. And this is going to serve not only the existing customers, but all the new customers that Dan is continuing to bring into the park. So this is a large project, and I've been working very closely with Dan and his team to deliver on the objectives of this project. And it's involved a number of different people with very different skills. And it's ranged from and we've developed it quite a bit in the last 1 year. So it's ranged from design to construction to putting the contracts together, permitting it, and even thinking about how we can burn hydrogen in this project in the future. So I think we've got a really excellent team at the RED project, which is already used to delivering these kinds of efficiency projects. So in summary, I think this cogen project specifically, and a lot of other projects that are coming behind it, will be using efficiency to deliver cost benefits that will add directly to the EBITDA margin and generate some attractive returns. That's how I would put it. Yeah.
Because it's all the cost savings that go directly to the benefit of RED, and that's where you see the margin improvements. Is that correct?
Absolutely. As RED makes its margin and creates its profitability from driving efficiency. So every project that we find that's above the returns that we underwrote goes directly to our bottom line, and that's how RED creates its profitability. And Sandeep, I mean, at any one time we could be looking at 50 to 100 potential projects that you could do on the park. And I suppose the trick of it is you've got to work out the ones that you can do that have the shortest payback, the highest returns, will have the most impact across what is a 1,200 acre site.
It's a good problem to have. In fact,
it's a good problem to have. Absolutely.
Dan and his staff are really worried that we have got a few large projects that are coming up. The Cogen is the largest, and there's a whole pipeline of projects that we are considering which ones can we really do in the time frame given these larger projects that are coming up.
And that comes into the sort of the capital discipline that we have and make sure that we're pursuing the best risk return profile for RED.
Absolutely.
Brilliant. So unfortunately, we're coming to the last question, the formal question, sadly. And you can guess what it is, which is, so what does success look like? What does a good outcome look like for RED over the next 5 years? Let's use. And John, I'll start with you, and Dan, if we could move on to you after that.
Sure. Yeah, I think we set a mission sort of roughly 2 years ago that we didn't want to just be the largest district energy park. We actually wanted to be one of the largest district energy players in North America. I think that is definitely achievable. We've put the platform on a really good footing over the last 2 years, and now I think we're ready to sort of expand that and grow from the base that we've got. And I suppose, what does that look like in terms of numbers? We think that we can nearly double EBITDA over the next 5 years, so out to 2028, and that is through all the initiatives that you've heard about today, onboarding new customers, delivering the capex accretive projects on site at better returns, and then looking at how we expand in the park and outside the park. But some really, really exciting opportunities there to do that.
Yeah, so I just expand on that. So first, fill up the Eastman Business Park, sell out of our services. We've got a very strong business development growth pipeline right now, to the point where we've got multiple potential customers competing for the same parcels of land. So it's a great problem to have. And when we do that, we complete these accretive projects, we'll achieve those, doubling our returns and exceeding everyone's expectations. And then we'll also start looking to grow outside of Red Rochester. As John mentioned, we're already one of the largest standalone systems in the U.S., so we'll leverage that. Not only the size and the complexity and our abilities to operate it very efficiently and reliably, but we provide services that most of the district energy providers in the United States don't provide. Most of them are focused on thermal energy. They either have steam and hot water for heating and chilled water for cooling. Some generate some electricity, but it's very limited to thermal energy for the most part. We provide so many other services. I think it's a real differentiator for us, as well as how we've executed these projects on the Red Rochester campus. When we go to look at targeting the Northeast, where there's a high concentration of campus-based energy systems, whether it be healthcare, higher education, other industrial parks, they're old and aging systems. We'll be able to leverage our experience in modernizing and optimizing these systems and show returns. So we should be able to do it more cost effectively than they're doing it right now. So I think that the market is ripe in the Northeast for someone like Red Rochester to go after those systems. I think we'll do it in a strategic way, targeting systems and trying to do it based on relationships that I've built and others have built, and try to do it sole source rather than through some competitive bidding process. But there will still go through some competitive bidding, I believe, but we'll do it mostly through strategic relationships.
Brilliant. Well, thank you for those comprehensive answers. And for the final time, I'll ask if there's any questions from the audience.
Yeah, straight away.
We have one behind you, Anthony.
Thank you. Keith Hiscott from Harbin. That all sounds very exciting. So what motivated the previous owner to sell the asset?
Very happy to take that. So the previous owners were a group called Stone Peak, which many of you may know, and their entry and investment strategy was very clear. They picked it up in 2016. They spent nearly $100 million to convert it from coal to gas. They brought on the first few customers, and it was an opportune time for them to sell based on their fund life, and see it was a natural acquirer who could take a long-term view and really grow that asset out. So that's why.
And then just in terms of the transaction, it's a relationship that SDCL has developed with the seller and worked with during the course of COVID to conclude with a successful transaction. So it was definitely is a relationship transaction.
Absolutely. A couple of quick questions. In terms of your counterparty risk, as it were, the customers, are the revenues that you're receiving, are they concentrated, as it were, from a small number of those customers, of the 107, or are the revenues pretty evenly spread as they come up to the company? And second question, in the interims, read what the valuation was increased because of the probability of some business development opportunities coming good. You've talked about lots of quite exciting things today. Which specific opportunities did the board have in mind when it felt confident enough to increase the valuation? Thank you.
Do you want me to take the revenue piece, and Dan, maybe you take the customers? Yeah, I think you have a couple of larger customers within the mix, but broadly you don't really have any customers that are tipping the balance more than, say, 10% on average. And actually you've got over 100 customers, and it's pretty well diversified across customers in industries as well. On the whole, so it is diversified. You also have joint and several liabilities. So of course, if customers leave, and the fixed base cost is spread across the other customers. In fact, customers are actually incentivized to bring more customers to the park, as the fixed cost base is shared amongst them all. So it's quite a unique structure, but it creates a lot of downside protection, a lot of diversification.
And I'd say, Dan, John, you spend a lot of time thinking about which customers are coming online to ensure that you maintain that diversification and credit quality.
Absolutely.
Yeah, we're seeing a great mix. So just a little bit more on the existing customer base. So Kodak is probably our single business biggest customer, but even within their operations, there's a lot of diversity from specialty chemical. They're still producing film. They're actually the sole producer of still film these days. Fuji brand labels Kodak film. They're developing reagents. They have a pharmaceutical line. They're feeding the food and beverage industry, various chemicals. So very diverse business. And then the new business is looking to come on is a little bit of a change, but it's actually very exciting for us, which really justified the cogen project. Is traditionally our customer base has been very high process steam loads, and the electricity basically followed that. We're getting a new customer mix in now that is higher electrical loads and lower on the steam. So it's a little bit of a conversion. We've created some custom rates. It justifies the cogen, and it's everything from lithium battery recyclers. We've got a dairy producer looking to come on campus, a fishery, and as well as a brewery. So great mix of customers.
Absolutely. Great. And in terms of how, I think the second question was, which is how do you as a board decide on the board development? I can add on to the valuation approach, but if you just want to talk about how you look at business development, that would.
Sure. So it's, like I said, we've got customers competing for the same parcels of land. So we work with those property owners to evaluate the customers coming on, everything from are they investment grade. Two of the customers, one is a Fortune 100 company, the other one's a Fortune 500. So very, very big and stable companies. And we'll focus in on, put a probability on it. So we'll really target those high probable customers that, again, are the highest and best use of that land on campus, which includes high utility demands. And we work with the Greater Rochester Economic Development. They do a very good job in outreach within the state, working with the state of New York, and finding and attracting, like from a fish hatchery to the brewery, and we work with them to really keep the above the funnel pipeline full.
And I think that's important to bring up about the probabilities, because you take the whole pipeline, you then filter it through.
Filter it down.
You then add on another probability,
That's
and then
right.
you agree at certain milestones, you'll add a certain probability. So there's a very coherent process as to how you bring them.
And we're estimating,
into
right
value.
up front, we ask them for all their expected loads, and we'll put a revenue and EBITDA number to it. And then obviously that helps factor in for us as far as which ones are we going to focus on to really facilitate bringing them on campus.
Yeah, absolutely. Yeah.
Brilliant. Any more? Otherwise, I will go back. Yes, I think Tom's got a question from his online crew.
Or he'll make one up.
Yeah, there might be Tom's questions.
So I don't know if you'll like this question, Dan. So it's probably for you, but welcome. John could probably answer as well. The question is, what's the one thing that keeps you awake at night?
So it's good and bad. It's all this growth and efficiency, the large number of projects that Sandeep mentioned. Not that I don't, I believe we can do it. It's just it's happening in a very tight timeline. I think we have the resources, we have the plans in place. We're going to be able to execute on that. But again, it's at a very fast, aggressive pace. So yeah, it might keep me up a little bit at night.
Anything?
I mean, not an awful lot to add, right? I mean, we came in with a certain investment case that we underwrote. I actually think we've generated more customers and more projects than even at the point when we underwrote the deal. Now we've got to make sure we deliver it, and bringing in Dan and Sandeep and the rest of the team, and you've got a great team on the ground. I think the next 4 to 5 years is very, very clear, and I guess we'll be judged at that point once this wave of projects and customers are actually onboarded. And hopefully we've got a business that looks sort of double the size.
Yeah, the next 3 years are going to be critical from just managing and executing these projects, big projects that are ongoing.
Absolutely.
Brilliant.
Yeah.
Okay, well, I don't think there's any other questions, so I will bring this panel to a conclusion. Thank you, Dan, John, Sandeep. Thank you for your time.
Thank you.
Well, great. Thank you, Purvi, for moderating all of today's panels and for all of our panelists. We've talked a lot today about how the investments that we're making are supporting our investment objectives, and how the projects together with the management teams will help us meet and exceed them. One thing I would say is, we are a few weeks away from the end of our annual, of our financial year end. We'll be publishing our financial statements shortly after that. Whatever you've heard today, I hope you take away the common philosophy I'll come on to behind our investments. We're not today making revenue, EBIT, or profit forecasts, but I hope you get a sense of the depth of revenue underneath our portfolio and the opportunity for growth. You've met a number of our most important investments, the CEOs and managers of some of the important investments. There are other CEOs and managers of other important investments in our portfolio here today, and just to call them out, Jesper, who runs Vattengas. So Jesper, you might like to say hi. So Vattengas is the very unique infrastructure investment. It's 150 years old. It's Stockholm's gas grid, but it runs today 70-75% on biogas. It's a pretty unique infrastructure asset. Very excited to have you here, Jesper, and I'm sure he'll be available to everybody afterwards. We've also got Reza from he's the CEO of EVN, the Electric Vehicle Network. So EVN is one of the sort of first and fastest moving electric vehicle charging infrastructure platforms here in the UK. We're very privileged to be able to support EVN building out a series of fast charging infrastructure assets for the likes of BP Pulse, and I think we broke ground last month on the largest one-off, I should say, but probably is the largest fast charging infrastructure station hub here in the UK, in Birmingham, at the NEC, and we'll be doing a lot more with Reza and his team. We've sort of got a lot going on, so very excited about that. We also have made another major investment during the course of last year. United Utilities built a series of a series of renewable energy projects connected to its sites, specifically connected to its sites across the UK, and mostly solar, but some other technologies, including wind, mini hydro, lots of floating solar and other assets. So we're very excited about having that within the portfolio and looking to support and grow that. This is, just to put everything into context of what you've heard today, this is one of the largest specialist portfolios of its kind in the world. SEEIT is a unique listed energy infrastructure company. It's got scale, it's got diversification, its net asset value, as we reported as at September 2022, was £1.2 billion. But together with its project debt, it's about a $1.6 billion, so around $2 billion portfolio. Albeit there being scale and diversification, I hope you've taken away today some common themes behind the investment philosophy, not just thematically around energy efficiency, that is generating energy efficiently at or near the point of use, reducing demand on the demand side, and promoting efficient distribution. But the common philosophy financially, that is contracts with our end customers, cash flows, and the opportunity to provide total return. So just to sum up, I wanted to sum up with thanks. I'd like to thank members of our board. We have members of our board represented here today: Emma Griffin, Chris Knowles, and Helen Clarkson. We are very grateful to our investors. Many of you here today have supported the company since IPO, and I'm very pleased to see you here and to be looking forward to a good and successful future for SEEIT and for your investment in it. So with that, thank you very much for participating today, and look forward to drinks.